What if I told you that the biggest financial shift in America is already happening right now, and most people still don't see it? Banks are entering crypto, Wall Street is buying Bitcoin, and regular Americans are slowly moving money into digital assets before the next big wave begins. But here's the question. Is crypto actually the future of finance in 2026? Or is this another dangerous bubble waiting to crash? In this video, we'll break down why Bitcoin is still dominating, why Ethereum matters more than ever, how smart US investors are using crypto ETFs, the biggest mistakes beginners make, and the safest strategy for long-term investing. This video is not hype. This is real information simplified for everyone. Let's get started. Section 1. Why crypto is still alive. A few years ago, many people thought crypto was finished. Markets crashed, big exchanges collapsed, millions of investors lost money. But despite all that, Bitcoin survived. And that tells us something important. Every major financial technology goes through chaos before adoption. The internet crashed in the early 2000s, but today the internet runs the world. Crypto may be following a similar path, especially in the United States, where institutions are now entering the market seriously. Section 2. What makes Bitcoin special? 21 million Bitcoin maximum supply. Bitcoin is different from traditional money because its supply is limited. Only 21 million Bitcoins can ever exist. No government can print more. That's why many investors call Bitcoin digital gold. When inflation increases and the dollar loses purchasing power, scarce assets usually become more attractive. That is one reason why long-term investors continue accumulating Bitcoin even after massive price drops. They see it as protection against the future uncertainty of traditional finance. Section 3. Ethereum is more than a coin. Most beginners think crypto is only about buying coins and waiting for prices to rise. But Ethereum changed everything. Ethereum introduced smart contracts. That means developers can build apps directly on blockchain networks. Today, Ethereum powers decentralized finance, NFT marketplaces, blockchain gaming, tokenized assets, digital payment systems. Many experts compare Bitcoin equals digital gold, Ethereum equals blockchain technology. Infrastructure. One stores value, the other builds systems. Section 4. Why Wall Street entered crypto. For years, large financial institutions ignored Bitcoin. Now they're entering aggressively. Why? Because demand became too big to ignore. The biggest turning point happened when Bitcoin ETFs entered the US market. Suddenly, traditional investors could buy Bitcoin exposure through regular brokerage accounts. No wallets, no private keys, no complicated exchanges. This changed crypto from a niche internet trend into a mainstream financial product. And when institutional money enters a market, everything changes. Section 5. Safest way to invest in crypto. Most people lose money because they enter crypto emotionally. They buy during hype. They panic during crashes. Smart investors do the opposite. Here's a safer strategy many experienced investors use. Step 1. Only invest money you can afford to leave untouched for years. Step 2. Use DCA. That means investing small amounts consistently, instead of trying to predict the perfect entry. Step 3. Avoid leverage completely. Leverage destroys beginners. Step 4. Use cold wallets for long-term storage. Keeping large amounts on exchanges is always risky. Security matters more than excitement. Section 6. Biggest mistakes people make. The crypto market rewards patience, but most people behave emotionally. Here are the biggest mistakes beginners make. Buying after massive pumps. Following influencers, blindly chasing meme coins, ignoring security, investing without research, expecting instant riches. Many people enter crypto thinking they'll become rich overnight, but the investors who usually win are the ones who stay disciplined for years. Section 7. The new crypto cycle. Crypto historically moves in cycles. After major crashes comes accumulation. After accumulation comes expansion. And after extreme hype, usually comes another correction. Many analysts believe the next major growth phase could happen between 2025 and 2026 because of increasing institutional adoption and Bitcoin supply reductions after halving events. But smart investors understand something important. Nothing is guaranteed. That's why risk management matters more than predictions. Section 8. How smart investors build portfolios. There is no perfect portfolio, but many long-term investors focus mostly on strong assets instead of gambling on random coins. A balanced example could look like this. Majority in Bitcoin, smaller portion in Ethereum. Small exposure to quality altcoins. Some cash reserved for opportunities. Diversification helps reduce emotional decisions during market volatility. Section 9. Is crypto actually the future? This is the biggest question. And honestly, nobody knows exactly what the future will look like. But one thing is clear. Blockchain technology is no longer being ignored. Banks are studying it. Governments are discussing regulation. Financial companies are building products around it. And younger generations are entering digital finance faster than ever before. Crypto may not replace the entire financial system, but it could become a major part of it. The biggest opportunities usually look risky before they become normal. That's why education matters. Move carefully. Think long-term and never invest based purely on emotion. If you enjoyed this video, subscribe to BW Info for more content about crypto, finance, technology, and the future of money. And tell us in the comments, do you think Bitcoin will dominate the future? Or is this just another bubble? Thanks for watching.